My name is Dan Pavilonis. I'm a senior market strategist here at RGO Futures. And this is Rolling Trades podcast for this week. And today I want to talk about the energy markets, crude oil specifically. OPEC plus moves, summer seasonality, macro signals, setups, WTI to 10-year yield correlation. And so how to play this seasonality and interest rate moves, since we've seen interest rates move much higher than where they've been over the last 20 years, and how that correlates with crude oil. So most recently in the news, we've seen OPEC raise production by 411,000 barrels a day. And what does this mean for the oil market, right? So initially, the market would look at this as, okay, they're adding to production, prices should be subdued, pressure going into these months. But we have to look at where they came from. In 2023, the setup was that oil was about to break below $70 a barrel. There was a banking scare going on. It was bearish for front month futures. OPEC plus comes in, they cut 3.66 million barrels a day, 2.2 million barrels of voluntary cuts by Saudi Arabia, Russia. They're trying to create a price floor, right? Because the economy was slowing down, demand weakness, China was slowing down, high interest rates cut demand. And the demand growth was about 1.1 million barrels per day per the EIA. So the technical impact is, the initial impact was oil prices jumped, right? And so the takeaway was the cuts squeezed the shorts out of the market. Saudi Arabia was looking to cut to pressure spec short positions, to unwind that position and move higher, for prices to move higher. And so now recently we look at the economic data that's been coming out, and it's been coming out much stronger than expectations, right? I think the expectation was that the U.S. Was going into recession. We need to cut interest rates to support the economy. And the Fed has not cut rates here in the U.S. Other countries outside of the U.S., we're looking at Europe cut rates. And to support the economy, but things are going fine here. So the correlation between the 10-year yield, the supportiveness of these OPEC raising production, and the support going into seasonality is all at play here. So we need to step back and look at these ups in production by OPEC as them trying to come back into the market, not let the market get out of hand to the upside. We don't want to see $90 oil. We also don't want to see $50 oil. We want to find some happy medium where people are fine at the pump. It's not going to curtail a growing economy by exorbitant prices. It's good for business, but it's happy for producers, and it's happy for the OPEC countries. And I think that happy medium is somewhere around $70 a barrel. So we sell off last month down to 55, and now we started to move higher. And as we're moving higher, OPEC green lights raising production. At the same time, the correlation between the 10-year yield and energies is pretty, it's correlated almost 1-to-1. Because if you think about the energy market, especially WTI, it's mostly tradable on paper. It's about $1 trillion in actual physical oil, but it's about $6 trillion in paper that trades off of it. So that paper is defined by the interest rate that paper's holding. So the 10-year yield is the closest correlation to that. So as 10-year yield goes up, there's a finite correlation between energy prices. So if we do get into a situation now, as the summer months start to pick up demand, but we also see the economy start to pick up. We see job growth. We see earnings come out better than expected. We see Europe bounce back. We see China bounce back. We might see a secondary inflation wave where interest rates start to move higher. And so because interest rates moving higher has that correlation with WTI, we should expect WTI to move higher, right? Because demand growth, international demand growth, and the longer term bond market, if we're looking at 10 yields on the 10s, yields on the 30s growing higher, whether the Fed wants to cut rates or not, that's telling you that the bond market, which is one of the smartest markets because this is all debt paper, is looking at inflation moving higher. And if you remember in 2008, we saw a situation where energy prices, even though the economy slowed down, interest rates went up a little bit, but the banks in the US used WTI cargo, energy cargo, moved it offshore into tankers as a hold of collateral, similar to how people would trade gold today, right? So, I mean, you're looking at an inflation hedge. Well, this is also another inflation hedge because it's highly financialized. So that's just something that I'm really keeping an eye on going into the summer months as demand starts to pick up. And I'm looking at these OPEC production raising production by 400,000 barrels is just a small step. They're trying to eventually get back to cover the 3.66 million barrels that they cut from production in 2023. So, we're 2025. Things are not as bad as they were. We're not going through a banking crisis. Yeah, there's some banter about cutting rates. Maybe that would be beneficial, but the economy is still there. And as we see drawdowns in inventories going into the summer months, we want to really focus on the summer months, the driving season, as they say. We want to start to look at drawdowns, how they're affecting prices in the front month. We're going into the June, July, August contracts. As we start getting into September, then we're going to start thinking about winter time. Things start to slow down a little bit. And then as we get into December and January of next year, we start to see another spike of just wintertime seasonality spike. So I guess at the base case, this is what I'm thinking about right now. And I just wanted to bring to your attention because I think a lot of people will look at these OPEC raising production as a negative for the market. They could have just raised production to fill that total gap of the 3.66 million barrels a day. They did, but they only raised it by 411. So we shouldn't look at that as something that's really going to cap the market. Maybe we don't see it go up to 90, but $70 seems to be a pretty relative level, kind of like a mean reversion, long-term mean reversion. So anyway, my name is Dan Pavilonis. You can reach me at 800-826-1120. And this is a wrap for this week's Rolling Trades podcast. Thank you.
The risk of loss in trading futures and/or options is substantial, and each investor and/or trader must consider whether this is a suitable investment. Past performance, whether actual or indicated by simulated historical tests of strategies, is not indicative of future results.